For my entire career, we've been worried about, from Greenspan on, what happens when rates go up. With the amount of debt we have, it's unsustainable. This year, that has shifted. The Fed fear has shifted from higher inflation is unsustainable because it'll bring higher rates on too much debt to what if the lower rates don't work? We're in an extraordinary time of an 11-year expansion, a 50-year low in unemployment, and yet the best we got is 1.6%. Steve Leisman had the interview with Williams today. He's saying that we got to get it to an average of 2%. How do you get it an average of 2% when it's at 1.6%?
The other thing I wonder about is whether you, because of all of the things that are up in the second half of the year ahead, is if you need to change the way and the kinds of stocks that you would look at. If you think that you've got a 6 to 7 month runway for those stocks to perform before all hell breaks loose and you get close to the election and who knows what happens in the lead up to that. You know what I mean? Some stocks you'd buy, you'd hold for a longer period of time. If you knew you had 6 to 7 months of calm, does that change the kinds of stocks you look at?
If you think you're in a much less risky environment, because every environment's risky, or a riskless environment, sure. Then you go with the highest beta stocks that you could find that are good companies, and you buy those because beta is going to lead the market. But I recall sitting here, I know I said it last year and the year before, you're going to get all your gains in the first half of the year. And that turned out to be the case, right? So there's spread out. We actually got great gains in the second half. Also, in terms of inflation, I think a little inflation would be phenomenal for the market because we'd see earnings growth come back. We need that for earnings growth. I think we're in a completely new paradigm of low inflation because of all the technologies come out and disintermediate the others because our ability to find resources on a much, cheaper basis. So I don't see us getting to 3%, but the question always is the pace of inflation picking up.
Well,
if the pace is under control, then we're okay.
Take a stab, though, at this idea of the kinds of stocks that you want to play in the kind of environment that we're in. Move away from the debate about inflation and go towards this idea that you have a potentially messy second half of 2020. And if that changes the kinds of stocks that you should be looking at.
Yeah, I would actually say it should. And the inflation conversation is part of this discussion, too. When you think about the setup for 2020, you may have higher rates. You may have steeper yield curves. And I do think you're going to have higher inflation. We're forecasting a 50 basis point pickup in inflation into the back half of the year. So if that's the case, what is the sector that is most correlated to this? It's actually the banks. It's the financials. To your point, this is the time to look at them again. And we went overweight on the sector.
I don't disagree about the banks. I think that they will outperform instead of market perform, which they've pretty much market performed this year. For all the moaning about how banks haven't performed this year, they've been at the market performance level. Some of them even better than that. But what I think you're also going to see, Judge, is with record low unemployment. Look at the earnings report today from Cintas, uniform company, right? I mean, these are the folks that are getting employed right now. I mean, knock on wood, none of us around the table have to wear a uniform here on the desk. But an awful lot of the folks that are getting employed right now are working at companies where they do. And this is a record earning report for that company. And that's exactly their strong suit. They do other things. They put in the, carpets in the buildings and all that sort of stuff. They do a lot that's directly involved with the labor force picking up, and it has, and they will.
Judge, the Fed has made clear that they're going to keep rates low because of inflation, which means the 10-year can go up. It's stimulative to growth. So rather than give opinion, let's talk about the data. When you've come out of these other two mini-recessions this cycle, the 2012 and 2016 mini-recessions driven by a slowdown in global manufacturing, financials, industrials, and information technology all did very well as the 10-year yield went up. The Fed was on hold, the 10-year rallied, and that is what is correlated to the more offensive sectors.